Welcome to the Daily Update, where I'll go over the action in the market for Thursday, October 26th, and then we'll see how things look for Friday, October 27th. We're still continuing to go lower. We're breaking below longer-term support, not only for the S&P, but on other indexes. There's still some support below where we're at right now. We're starting to get to more of an oversold condition, but things are looking pretty negative at this time. However, as I record this, and this is many hours before the market opens, the futures are quite strong on the heels of the Amazon earnings report. We'll have to see if that can carry through into the cash session and actually turn things more positive. Let's go back and talk about what happened. We did have a lower open and prices dropped below S1 at 41.68. Then prices attempted to rebound back above S1, and then they fell down all the way to S2 at 41.49. We found support at the 41.30 level. That was about the point from the July high, and we got down to this 41.30 level, and that was about a 10% decline. That's when we saw some buyers try to come in, and it pushed things a little bit higher, only to come right back down and settle about at that level. Prices then rebounded back to S1 before falling back to close near the low. We were down 1.18% on above average volume. We are negative across the board, short, intermediate, and long term. We're looking more overextended to the downside in the short term and somewhat in the intermediate term. It's about inflation, interest rates, growth concerns, what's going on in Israel, and we're going to get a big inflation report coming out in Friday's session. Some comments. Mega caps were really weak, and Meta, Facebook, really declined. They came out with a good report, but when they started talking about what the future looks like, their guidance, well, the market didn't really like that as much, and the stock ended up tanking. Then the European Central Bank, they did leave rates unchanged. Now, this is after they've been raising rates 10 times in a row. To see them left unchanged, that's rather positive as far as interest rates are concerned, but it didn't really feed into the market all that much. We're still waiting to see what the Fed is going to do. The S&P, as I said before, did fall down to 41.27. That was today's low. That was a 10% pullback from the close that we saw on July 31st. And this is just above going now into a new correction territory. So if we do fall more from here, we're going to be heading into the textbook definition of a correction. Small caps and mid caps were actually up. They were the stronger part of the market in Thursday's session. Oil was up to, actually it was down. I forgot to change up to down. It fell down to 83.06. The micro caps, they ticked up a bit. They fell, or they went up with the small and mid caps, but they're still very near that 52-week low. Here's our short-term list with the Stochk RSI, the Williams Percent R, the Force Index, the CCI 14 and 20, the Stochastics, the RSI 9, and the Boom 20, and I'll go through all of these charts. The 20-period exponential moving average study that had been on here has now fallen off, but we still have the 50-period exponential moving average study in the intermediate term, where we also have a new addition, the standard deviation, the Arun, which is acting even more strange now, the PMO studies, the Sean trend meter, and the S&P 500 bullish percent index. Long term, we're still showing an extreme negative reading with the 150 and 200-day moving averages. We're still really battling through this same scenario. It hasn't really developed into anything new, that the economy is stronger than expected, and we got some strong economic news in Thursday's session, and that's part of what fed into the negativity, that the Fed will end up keeping rates higher for longer and possibly even have to raise rates, keeping an eye on the Chinese economy as they're adding stimulus there, keeping an eye on what's happening in Israel, keeping an eye on oil prices, and then we're dealing with earnings season. The dollar was up and interest rates were down. Now, interest rates going down could have given some support to stocks, but they really didn't do that in Thursday's session. We have the 30 to the 5 and the 10 to the 5, which are back to being normal. And I have charts of these where the 10 to the 2 and the 10 to the 3 month are still inverted. I also have charts of those. Excuse me, had to clear my throat. Sentiment continues to be negative. We had been at 30. We're dropping down to 26. If we drop below 25, that's when we start to get extreme negative. And at that point, we start looking at using this as a contrary indicator. Our trend is still negative. The ADX is above its moving average and going up. They're both above 20. That's a confirmed trend. Our bias is negative and our momentum continues to be negative. The economic reports that came out, and I don't have charts of all of these because they don't have a big impact on the market, but I do have charts of the weekly jobless claims. They came in as expected, being up 210,000, where last time they came in at 200,000. Continuing claims, we're seeing this really starting to pick up, and that could suggest some economic weakness. It came in at 1.790 million. Last time it was at 1.727 million. Durable goods orders. This is another thing that you could say spooked the market. It came in stronger than expected at 4.7%. They had expected it to come in up 1.5%. Last time it was down 0.1%. When you take out transportation, we were up 0.5%, more than the 0.3% they had expected. Last time it did come in up 0.5%. These are the areas that I don't have. Oh, I'm sorry. That's later on. The GDP. This is the first time we're getting a look at this number. It came in a lot higher than expected at 4.9%. They expected 4%. Last time it was at 2.1%. Right now, this is showing pretty healthy economic growth, and that could concern the markets right now because we're still going through that phase where good news is bad news. When you look at the chain deflator, it was up 3.5%, more than the 2.7% they had expected, and up from the 1.7% we saw last time. This is the area where I'm just going to talk about the data and not show charts. The advanced international trading goods came in minus 85.8 billion. Last time it was minus 84.6 billion. Retail inventories were up 0.9%. Last time they were up 1.1%. Wholesale inventories were unchanged, where last time they were down 0.1%. I do have a chart of this. Depending home sales were up 1.1%. And we've been seeing a pretty weak real estate market lately. They expected them to be up 0.5%. Last time they were down 7.1%. Here is the look at durable goods orders, where we're climbing back up. We came close down to zero, and now we're starting to turn back up. This is positive in and of itself, but it could be giving some fear to the markets. When you take out aircraft, we're still just a little bit above zero, even though it has been declining. Month over month, we saw a pretty big increase in durable goods orders. Another reason that good news is bad news. When you look at GDP and then the deflator, the GDP is the blue line here, where it's really going up and really quite strong. A good, healthy GDP tends to be about 5 or 6%, but we're also seeing the deflator, which is an inflation gauge inside the GDP. It's continuing to go up. Personal consumption year over year is also going up, and the next net exports are pretty much flat right now, showing that we're taking in more than what we're exporting out because we have a negative number. And then real GDP, this takes into account inflation on a year-over-year basis. It's up and has been going up, suggesting that maybe we're going to not go into a recession after all, at least based on GDP. Here's the pending home sales, where we saw a big tick up here. They were down 18.7%, and they were down this past month on a year-over-year basis, but they're down 11%. Weekly jobless claims did see a bit of a tick up. We're starting to see the moving average turn up ever so slightly. This is a 4-week simple moving average, and that's what we follow mostly. The continuing claims are also continuing to go up, which is suggesting that maybe the labor force is starting to weaken just a little bit. Then we look at all of this together. We have the initial claims, which is the red line. And then we have the blue line, which is our continuing claims, and then the latest unemployment rate that we received a few weeks back. We closed at 4.85% for the 10-year yield. That's still well above the 4.02%, which is pressuring earnings for companies. Here's the intraday chart where we did have a lower open. We quickly went down below S1. We tried to set up some kind of a base here. We didn't see an awful lot of choppiness, but then we ended up breaking down below S2. This was the area where we found some support, which was a 10% decline from the July 31st high that we set, at least on a closing basis. And then the market tried to rally up off of that, only to stop at S1 and then come back down and close pretty much at the low for the session. We're seeing growth and value continue to be weak. Both of them were down. And then we're also seeing, this is a bit of a concern too, our growth to value ratio for the S&P is really underperforming. And this had been a strong part as we were looking a little bit better, but now we're starting to see a longer term downward movement with this ratio. But on an end of day basis, the growth to value ratio is still holding up. It was pretty much flat, and it still continues to be in an uptrend. Keeping an eye on discretionary, which continues to decline, seeing a recent death cross with our equal weight ETF. We actually are chopping more or less sideways with the Staples equal weight ETF. But overall, the ratio continues to decline. However, the blue line's above the red line, so we're still in a longer-term uptrend. Here's the condition of our trend with the ADX above its moving average, and both are above 20. This is a confirmed trend. It's a downtrend because the red line's on top and advancing, where the green line is declining. Here's the short-term version of that same indicator, suggesting that we're still in a confirmed downtrend. Keeping an eye on the VIX, which is, I don't know, we have to see how it plays into this average price over a period of time. The Ulcer Index does show that fear is beginning to, let me back that up. The Ulcer Index continues to show that fear is increasing. Looking at the VIX, we're back above 20 with the line chart, and we're back above with the bar chart, although we did close near the lower end of the bar. Volatility is actually ticking down just a little bit. We saw a real increase in volatility ahead of the weekend. It started to fall back. Well, now we're coming up to Friday's session. Are we going to see a pickup in volatility as folks protect themselves over the weekend, given what's happening in Israel? The VIX to VVIX ratio continues to go up. That's longer term negative. The VIX to VIX 3-month ratio is also continuing to go up. That's the red line. That's negative. The VIX to move ratio is also going back up. That just shows there's more volatility in stocks. Here we have another one-day look at the equity put call ratio, which actually went down. It's kind of surprising. On a down day, we saw this go down as well. So I'm not quite sure how to handle this. We're ticking back up just slightly with our 5-period equity put call ratio moving average. I'm still kind of leaning more towards this continuing to go back up because we're looking more negative. We had been really declining, but now we're starting to go back up slightly. Longer term, we're continuing to go up with our long-term equity put call average, with our long-term equity put call ratio moving average. And we tick down just a little bit with fear on this chart, and we're ticking up a little bit more with the fear on this other chart. We did get the latest reading of the American Association of Individual Investors. They're getting more pessimistic now, but not necessarily extreme. Remember, this group, which includes us, we tend to react to what's already happened in the market instead of looking ahead to see what will happen. And as the market goes up and down, these folks tend to follow that, but they're not giving us an extreme negative rating, at least yet. The risk on to risk off ratio continues to decline and is in a pretty solid downtrend currently. The mass index is starting to roll over. It never got up to the blue line. So even if this continues to go down, that would not necessarily be a valid signal, according to that chart. The advanced decline line based on price is still showing weakness as well as volume. And we're really coming down with our 5-period and 10-period moving averages of the new highs and new lows. We did see fewer new lows here, but they're really outnumbering the new highs. The advanced decline ratio is below 0 and declining. That's negative. Accumulation distribution is below a declining moving average. This is a smart money indicator and is negative. The chicken money flow is looking even more negative and now turning down with its moving average. That's negative. And we're just dropping below support here. We didn't really find anything at this other pivot level as we're continuing to free fall currently. We are seeing volume is above average. You could suggest that with a real pickup in volume, we might be getting to some kind of a climactic event on the downside. And then over a period of time, we're also seeing how our volume has been above average. This is the one-day rate of change chart, which I showed in yesterday's video, and I'm continuing to show that because we're below this green line. just to show that we're going down pretty far, pretty fast. The Stochc RSI, one of our short-term oscillators, that's continuing to be extreme negative, as is the Williams percent R, the CCI 14, and the CCI 20. So we're getting pretty overextended in the short term. We did tick back up just a little bit with our 20-period exponential moving average. We're just barely above the 20 level, which is where I have the line here. We're still extreme negative with the 50-period exponential moving average, and we continue to decline with the 200. The force index is now starting to look a little extreme. We hit the lower Keltner band here. That means that we've gone down pretty far, pretty fast. And our stochastics, we're looking extreme negative in the short, intermediate, and long term currently. The boom indicators dropping further below this 100 level. That means we're getting far away from the 20-period moving average, where we continue to decline with the 50 and getting close to an extreme reading. We're dropping below zero and turning more negative with the 200-period moving average. This is kind of strange. The Arun indicator actually ticked up a bit. It still shows the red line on top. That means the sellers are in control, but somewhere it picked up that a lot of buyers came in, and so it's shooting our oscillator back up, but it's still negative overall. Looking at the cumulative NYSE advanced decline line, we're still showing more weakness, even though it ticked up just a little bit. The broader market actually held up a little bit better than the mega caps. We're down here, we're coming back to this previous low, wondering if that will provide us some kind of support with our regular NYSE advanced decline line. This is also a little bit potentially positive. The Swenlin trading oscillator based on price and volume, they're still negative, but they're starting to turn back up slightly. Sometimes this can be a leading indicator for us. However, the go, no-go system is still a deep purple negative. The TTM squeeze is looking more negative, showing that momentum is negative now. The balance of power dropping below the midpoint and is negative. We're starting to drop with our highest high, lowest low values. The midpoint's going down and the red line is starting to go down as the blue line is flattening out. We're still below the 200-day simple moving average. The vortex saw a spike up with the red line and a decrease with the green line. That's negative. The ease of movement is dropping further below zero. That's negative. The bullish percent index for the S&P continues to drop and is below 30. We're waiting to see if this is going to bottom out, turn and go back up, and then cross back above 30. Our summation index based on price and volume continue to decline. Our NYSE summation index based on price and volume also continue to decline. You could see a little bit of a divergence here where we're breaking down more based on price, but we haven't broken to a new short-term low based on volume. We continue to be negative with the S&P when we look at the Elders Impulse system. The RSI on 14 periods is negative. We're starting to get extreme negative with the 9-period RSI. On balance volume continues to decline below a declining moving average. And we're seeing the 200-day moving average study actually decline a little bit faster than the 50 period. You could take that as negative because it's longer term. You could take it as positive, meaning that maybe we're washing out here and we'll be able to set some kind of a bottom. We're coming down to this other 100% retracement level on our short-term fib chart. We did bounce up off of that, so this support is holding for right now. Longer term, though, we're breaking below the 50% retracement support level, and that is more negative. Then longer term, we're below this 4208 level, and now we're continuing to fall. The next level that I have here is another double fib level at 4020. We're also breaking below this quadrant level now. This had been holding up as support. We're now closing down below that. That's other support that is being broken. And the Pring bottom fisher, it's finally starting to wake up and say, well, maybe things aren't so good after all, but it's still generating a buy signal. Momentum shows that our PMO is negative. We're also now comfortably negative based on price and volume below the moving average. We actually ticked up a little bit with the PMOs that are rising. We continue to decline with the buy signals, and we're starting to get extreme negative with the PMOs that are above zero. We're continuing to decline with the NYSE bullish percent index, and we haven't hit 30 yet. The NASDAQ 100 bullish percent index also declining, negative, and have not reached 30. So our short-term momentum for the slope oscillator continues to be negative. The MACD is more intermediate term. That's negative. So all of our oscillators now are crossing over negative. The tricks and the KST are ever so slightly crossing below their moving averages. And we're well below the 200-day simple moving average. This is one that I haven't had to show for quite a while. This is an anchored moving average going back to the all-time high. We're coming back down to this level now. This is a pretty significant line in the sand to see if the market's going to be able to find support at this level. We are suggesting now that we've gone down a little too far, too fast with our standard deviations chart. We're in the -3 standard deviation. Chaikin oscillator is below 0 and declining and not extreme yet. The money flow is below 50 and declining. That's negative. Ultimate oscillator getting close to being extreme, but not quite there yet. The Sean trend meter is extreme negative, and we don't get a lot of readings from this chart, at least lately. The parabolic SAR shows the dots are on top, and that is negative. And we're dropping below this other more textbook trend line that I tried to draw here with the blue line. We actually closed a little bit below this. So this support is just not holding currently. Our 150 and 200-day simple moving average study, we're starting to get extreme negative with both. And the daily special K, it looks like it's coming down ever so slightly below the red line. So we're counting that as negative unless we see this really improve and start to go up. We don't get a lot of signals with this chart. We did have a signal at the beginning of 2022. That ended up being a very valid signal. And we didn't cross comfortably back over positive until this past summer. Now we're starting to cross over and go negative again. Looking at Dow theory, where we're still above support right here based on the Dow, but we're seeing a lot of weakness in the transports. Utilities are bouncing back up, and the transports are really underperforming the Dow. So when we look at our ratio between the transports and the S&P, this is really falling lower. That is negative. And the correlation between the S&P and the transports is still quite strong. When we look at the ratio between the Dow and the transports, this is going up, meaning that the Dow is outperforming. In a more solid environment, we want to see this ratio going down. The Sahorchak still hasn't generated anything different, but we're coming off of that buy signal. Also, keep in mind that there's a one-day lag with this chart. We have to wait until the end of the next day in order for this to be updated. The Staples S&P 500 ratio is going back up. That's negative for the S&P. The S&P to utilities ratio is going down. That's negative for the S&P. We're seeing some weakness here with our 10-day average of the S&P high minus the lows, where we're starting to come back down after giving an extreme negative reading. We were showing some improvement, but that's starting to work off now. And our 19-day exponential moving average of the advanced decline ratio also turning more negative based on price and volume. The micro caps did bounce up in Thursday's session, but they're just coming off of a new 52-week low. The Heiken Ashi continues to be negative with black candles. The Kegi is negative with a red line pointing down. The Renko is negative with red boxes, and the three-line break continues to be negative. We have another zero drawn on the point and figure chart. No new signal has been generated. This is just turning more negative. The signal that was generated is a double bottom breakdown. Sounds like a great dance. That was generated on September 26th. And we're seeing here on this next chart how the equal weight index is really underperforming the weighted S&P 500. And this ratio is starting to come back down. It had been holding up over the last few days, but in Thursday's session, this ratio did decline. The Dow broke below support here. It had been building up this support level at this pivot point. We ended up closing down below that. And if we stay down here for any length of time, we could generate a death cross fairly soon. The diamonds continue to be negative. And the NASDAQ 100 also breaking down below support. Are we going to come all the way down to the 200-day moving average? Is that what's going to finally provide support for the markets? We're a bit away from that now, but that could end up happening. The elder impulse system for the Qs remains negative. The NASDAQ 100 momentum is still negative with the PPO below zero declining, and it's also below its moving average. We're breaking below the 61.8% retracement level for the NASDAQ 100, which had been holding up. This is showing more weakness. The NASDAQ is now breaking below its 200-day moving average. That's more negative, so we're losing support there as well. And the NASDAQ is coming all the way back down to this 31.8%, 38.2% retracement level. At least this is holding so far. Is this going to provide some kind of support if we continue to fall? If we break below that, that's going to turn things in the NASDAQ a lot more negative. Small caps continue to be negative, even though they were up. We're working off of a recent death cross. The Russell 2000 showing a little bit of improvement with the RSI. Recent death cross coming back and testing previous support. On a momentum basis, though, the MACD is still negative. And we're switching back to neutral for the Elders Impulse system for the small caps. We are still above this pivot point for the mid caps after giving us a recent death cross and wondering, are we going to find some support at these previous levels? But we still remain negative for the Elders Impulse system for the mid caps. The FANG index is showing a lot of weakness. It had been holding up because these are the big mega companies. But as they're getting hammered right now, this is continuing to fall further below its 50-day moving average, but longer term, we're still in an uptrend. We're also keeping an eye on this longer term FANG chart because now we have broken below previous lows, and that's not a good thing. We're also getting further below the arithmetic scale chart going back to 2009. And we're seeing weakness with the Qs to S&P. We're also continuing to see weakness with discretionary to the S&P. Large cap growth has dropped down below its moving average when compared to large cap value. So the growth to value ratios with the large caps, mid caps, and small caps are showing weakness. The 50-day exponential moving average of the new highs minus the new lows continues to decline. Because our black line, which is the indicator, continues to be below zero, that's dragging the 50-period moving average red line lower. Looking at the stocks above their 50-day moving average for the S&P, we're seeing some weakness, even though it bounced up just slightly. The mid caps bounced up just a little bit and never did give us an extreme negative reading. We're bouncing up just a little bit with the small caps. When we look at the broad range of highs minus the lows and take a 5-period moving average from the Amex, NASDAQ, and NYSE, we're continuing to fall here. That's showing a broader range of negativity. The dollar continues to go up, which is part of the reason stocks are really struggling right now. The financial sector, it hasn't generated a death cross yet, but another day or two, and it's likely going to do that. It's well below its 200-day moving average. For right now, this support level is holding. If we fall down even more, we'll be watching this level. Yes, we could fall down below this, so we're kind of watching this general area as support. Bonds actually saw yields going down for the 10-year. That didn't give support to stocks, but they're still at pretty high levels. Here's the 30 to the 5, which continues to no longer be inverted, as is the 10 to the 5-year. We're seeing some improvement with the 10 to the 2-year yield curve. Even though it's still inverted, it's starting to come back up. And we're also seeing a little bit of an improvement with the 10 to the 3-month. We're seeing a pretty strong correlation when we look at the 10-year yield and subtract the German 10-year yield. That's still giving us a positive answer. That's why this is going up and the dollar continues to go up, and the correlation between the two is still very strong. Tom Bowley's research, we're kind of in this part of the month now where we tend to see some negativity. After we get through this weekend, we might start to see some improvement from a bounce coming up early next week. That's just historically what has happened. We'll have to see how it actually plays out. So our outlook for Friday, earnings reports are still coming out. We did get Amazon's report, and that has been giving a little bit of support to the market. There is some progress that we're seeing with the UAW strike. We do have a new Speaker of the House. His name's Mike Johnson. People are now scurrying around as fast as they can to find out what they can about him. We're still watching the situation in Israel and wondering if that's going to escalate. In some ways, it already has, but it hasn't escalated the way a lot of people thought it would. The technicals are negative, and we're breaking below long-term support. We will get personal income and sales and PCE prices. This is the other big inflation report for the month. We're also going to get consumer sentiment. And then we're keeping an eye on all the different geopolitical events, with Israel pretty much at the top of the list right now. Here's the calendar showing what's coming out on Friday. Stock Traders Almanac statistics. We're neutral to negative with the Dow. We're just flat out negative with the S&P, where we're neutral to positive with the NASDAQ. So we run the whole gambit here. We are finishing up the week after options expiration, which tends to be more negative. We will be on the 20th trading day of the month during a pre-election year. The green dashed line, that does give some support to the S&P. We're also wondering if we're in this downward movement here with the green line when we have a sitting president who's running for re-election. Also wondering if we're seeing some weakness based on the Carson research. The NASDAQ, it looks like we're in this downward movement right now before we see a bit of a bounce up at the end of October, and seeing pretty much that same thing for the S&P during a pre-election year. We tend to be a little bit more up than down, going back to 1950 when we look at the S&P during pre-election years. Looking at Bitcoin, it fell back just a little bit on the chart that I have to show you, where it got up into the 35,000 area and now has been pulling back into the 34s. So our scenarios, we have to go with the down one right now. We're negative and we're breaking below long-term support. You could start to make the case that on a short-term basis, we are overextended to the downside. We'll have to see if we end up getting some kind of a bounce from that. We cannot justify going with the upward trend right now. Our charts just don't support that. And we're no longer going sideways because we are in a confirmed short and intermediate term trend. So our warning signs, I've put the daily special K indicator over on the negative side now because it looks like it's dropping below the red line. Our longer term equity put call ratio is going up. That's negative. The risk on posture showing weakness. And even though we're ticking down just a little bit with our equity put call ratio, we have really been going up with this. That's why I have the asterisks here. Our momentum is still negative, both for the S&P and the NASDAQ 100. The BPI for the S&P is back below 30. The Vortex and the parabolic SAR chart, both are negative. Our 50-period exponential moving average study of the new highs and new lows continue to be negative. The Russell, the small caps, and the mid caps are working off of recent death crosses. Positive signs, getting kind of thin on this list. The Pring bottom fisher, yeah, how about that? But it's finally starting to wake up a little bit and realize maybe I didn't do the right thing here. Small and mid cap growth, even though we've been seeing some weakness in this, is in a longer term uptrend. The financial sector could be getting ready to generate a death cross, even though we still count it as a golden cross until that happens. Pretty lean list there. So we are negative. We have a confirmed trend and we are below longer term support. In the short term, we're becoming more oversold or extreme negative. We're below support in the intermediate term and we continue to be negative in the long term. Thank you. I hope you found this helpful. I hope you have a really good day and I will talk to you in the next video.